shareholder Kevin Simpson, Capital Wealth Planning founder and CIO. Kevin, good to see you. Obviously, Netflix, it's a deal stock now. It's way off its levels from before it agreed to buy Warner Brothers Discovery, or most of that company. Shareholders have kind of voted that it, changes the story. Maybe it's not what they bought Netflix for. But how are you viewing that deal in conjunction with what you expect to hear from earnings next week?
Yeah, I think, Mike, that Netflix is going to really be under the microscope on Tuesday, but maybe not for the reasons that we think. Traditionally, we want to go into the earnings season looking at the numbers, analyzing where they've been, what the guidance looks like, especially after the last quarter. Netflix missed on operating margins, so that will be an important statistic. Bigger picture, analysts are expecting about 16 to 17% revenue growth. That translates to just under $12 billion, about 55 cents a share. So a decent report. All things being equal, you would be impressed with Netflix's number. The stock might go up a little bit. But really, I think it all boils down to the post-game presser, the conference following the earnings report, and listening to what management has to say about the acquisition. Because without any information there, you've got a stock that's going to hover around these prices probably for the next 12 to 18 months. Stock's actually off 25 to 30% from its highs. Yeah. So I'm going to be paying a lot of attention to the earnings call.
Would you prefer that Netflix complete this deal and that they prevail, or if they walked away and everybody could refocus on the long-term secular story?
I'm kind of torn there, Mike. I mean, I wear my heart on my sleeve. I love this stock for the long term. I think the acquisition's incredibly accretive. As a consumer of the product, you think about Harry Potter, Game of Thrones, The Sopranos, DC, kind of what all these things could look like in a Netflix ecosystem. But as a short-term, capitalist, it would be better probably if Paramount Skydance came in, took the deal, wrote a check for $2.8 billion to Netflix, and we would see the shares go up appreciably. So I think shorter term, it might be better for them not to get it. Longer term, I definitely think it's a phenomenal acquisition and really their first one and one of massive consequence.
Sure. Yeah. I mean, obviously, they're not making any more 100-year-old movie studios after Warner's that you might be able to get down the road. In terms of, now they're no longer giving subscriber numbers at Netflix. What's your thought about the strategy of more in live events, the podcast initiative, and all the rest of it? Is that showing that Netflix is consolidating its advantage, or it's kind of stretching for growth?
Yeah, that's a good question also. I'm of the camp that they're doing things smart and that they're doing things for profit down the road. The idea that they're bringing live sports into the Netflix universe is something that they said they would never do. They also said that they would never have advertising, and we know how well that ad tier is playing out and will continue. The more they get the sports right, the more they get the advertising right, it's just an incredible trajectory for margins moving forward. The podcast acquisition of iHeart is good. You've got Spotify, which is a fantastic company. I don't think this eats into that too much, but I think it just broadens Netflix in the right way. WWE, some of the boxing exhibitions that they had have been really cool. NFL and everything else that they can do with live sports moving forward. It's an incredible runway. I mean, I think if you look at this pullback as an opportunity for an investor, you can certainly buy the stock here. You just can't expect to see a whole lot happen, again, 12, 18 months like in your thesis until something happens with the acquisition or not.
Yeah, for sure. Just to pivot, I mean, and some other stocks on the move, and I know Delta Airlines was one that caught your eye. It obviously pulled back on pretty good results. So what's your view there?
Yeah, we bought this in the growth strategy. I mean, I honestly can't remember the last time we've owned an airline. They had an earnings report that we thought was really solid. And like a lot of companies this earnings season, and I know it's still a small sample size, but they give somewhat tepid guidance and the stocks sell off after the earnings. We looked at that as an opportunity to buy and initiate a position in this name. I think the market still thinks it maybe a little bit incorrectly from a free cash flow story that we're looking at. $3 billion in free cash flow is a really big deal. This is all about the front of the plane, profit margins, best of breed, best in class. If the business traveler, if the international traveler continue, to engage the way that they have, they've really got their debt story, their debt problems put behind them in large part. They're paying a dividend, they're buying back shares, they're fiscally responsible. You have to think about energy costs as you do with any airline. But I think if we're going to own one, this gave us an opportunity to sneak in a little bit cheaper than maybe we should have gotten the stock. And I like it longer term, provided they continue to deliver.